I'd like to thank all of you for coming tonight. We really appreciate all of you. Tonight's meeting is going to be a little bit different than what we've done in the past. In the past, we always invited one of our platform partners to come and talk about their deals and what was coming up next. We've had a lot of requests for an All Pro Capital centric kind of seminar. So we're going to talk about that today. We're going to talk about kind of where we were, where we are today, hopefully where we're going in the future. Again, all of that is because of your support and you being with us along the path for the last 15 years. To start us off, though, we're going to show a little video, a testimonial of one of our investors and his experience. We'll kind of pat ourselves on the back a little bit, and then we'll take it from there.
At the very, very beginning, we were probably a little more hesitant, just it was our very first time investing with them. But the first investment did so well that our investments after that, we were much more trusting of the return. And every investment's been awesome.
All Pro has always returned the returns that they projected. And in most cases, the returns have actually been better than they projected. But aside from the financial returns, they're just great guys to work with. They're good people. We enjoy working with them. The communication's great. Since we've been onboarded with them, now they've got an app that or online, I can go look at my investments, how they're performing, all the way from the beginning of when I first invested almost 15 years ago.
Because we were in so early and had such a positive experience, just talking with other friends who were looking for investments, and we encouraged them, and all of them have had the same experience that we have, just with the amount of returns and experience with communication.
If you're looking for an investment where you know your money is going to be safe, you're going to be investing with someone who's genuine, who's honest, has a background of returning the projected results that they have offered, I think it's a very safe investment. The incredible part about All Pro Capital is we've always had a return on our investment as projected. They've never missed a payment to us in 15 years.
Before anybody asks, that was not a paid endorsement, okay? Maybe it was paid because he invested with us for so long. Anyway, we appreciate we appreciate those kind words, and we hope that you are having and will have a similar experience to what the Fords have experienced. So I'm going to, oh, by the way, I should introduce a few of us around here. My name is Steve Ossis. I've been with All Pro Capital since the early days, the first day actually, of 2011. We'll go to let's see here. There we go, pictures. Brian Barr is our founder. He started All Pro Capital, and Tony Bettis is the CEO. Eric Como, you'll hear from both of them today, is our president, and then I'm the vice president over investor relations. We also have in the audience, John Barr is back in the corner. He's our senior financial analyst. Blaine Webb is investor relations manager. Maura is here. There she is. Everybody knows Maura. We couldn't survive without Maura. She is the director of client services, which is a new role that we can talk to you about later. And Janine is here somewhere, and her husband, I know, somewhere. And I think there's Janine back over here. Thanks. So those are the All Pro team that's here. We have a lot of folks working with All Pro that weren't able to be here, that are out of town or doing other things, but we wanted to introduce you to the team that was here. So let's go through kind of where, I don't know where to stand. Maybe this side, that side. Oop, went the wrong way. Going back here, so as hopefully all of you know, our motto or our goal is to create wealth for our investors by thoroughly vetting the investments that we have, making sure we have the right platform partner, the right deals, that is structured the right way so that you can make money and All Pro can make money. I keep hitting the wrong button. Okay. So let's talk about where we have come from over the last 15 years. 2011, when I was first brought in with Allpro Capital, we had 7 investors. As of last week, we have 1,021. So we've grown exponentially over the last 15 years. The thing that I'm most proud about is this 93% investor satisfaction. So hopefully that clip at the beginning wasn't just a one and done kind of thing. Hopefully all of you are and will experience that level of satisfaction with your investments and with your interaction with Allpro Capital. As far as the money that we have invested, we started off in 2011 with a couple of land funds. We had $3 million basically of invested capital. We have grown that year after year after year. Right now we're sitting at about $580 million of money under management. We have, as you can see, if anybody knows Brian Barr in this audience, he's not one to accept the status quo. And that's why you'll see these graphs always going up, is under his direction. We've been tasked with growing assets, growing investors, growing everything. We never stand still. Some of the highlights that we wanted to bring out, this is just the active, closed, and the total number of investments that we've had overall. A couple of things that I like is overall, if you meld all of the returns that we've had on our closed project, it's 21% on average for those closed projects. So also, if you include not just the money under management, but the actual assets under management, Allpro is managing about $1.4 billion of assets under management. Now, are we fulfilling our motto? Are we doing what we're supposed to be doing or what we were set up to do? And how do we measure that? Part of that is creating wealth, right? That's our motto. We're here to create wealth for ourselves, for our partners, our employees, for our investors, everybody. We have our estimated wealth creation is $272 million of that's wealth that's been created, wealth that's been created through our projects that has benefited our investors, our employees, our platform partners. That's just wealth that has come about because of the projects that Allpro Capital has initiated and funded, and because you were helping us do that and help us fund it. We've created $272 million to date for that. So that's something I'm very, very proud about as well. 55 open projects. So in a nutshell, that's kind of where we've been, how we've grown. I look out in the audience. Leo, I think, was one of our very first initial investors, and he's still around and with us, and I'm glad for that. And I'm so grateful for all of your support, because honestly, without your support, without your confidence and trust with Allpro Capital, we never would have been able to have these type of results that we're having, the growth, the creation of wealth that we've experienced. That's really due to your trust and confidence, and I really appreciate that. So now I'm going to turn the time over to Tony Bettis, our CEO. I got the name and title right. Last time I forgot his name and didn't introduce him, so he'll take it from here.
We'll see if mine works. There we go. I talk pretty loud anyway, as most of you know, so probably didn't need the mic. But thanks for coming tonight. I do want to mention that we're going to mail this out to anybody that wants it digitally, as well as a recording of this. So you don't have to, it's always really hard to follow and people are taking a bunch of notes. And so we'll send it out, the recording of this entire event and the deck in about 30 days. So don't worry about trying to take a bunch of notes, just relax and try to learn something if we can help out. So Steve went through that amazing growth, and the company's been around 15 years. I started 10 years ago this year. And that's why I was brought on to help scale the company, and Brian didn't have the time to run it daily, and I was brought on to scale. And what's super important about all of that is, of course, a lot of hard work from us and all of your dollars, but we really owe a great debt of thanks to our platform partners. And anybody that's been with us for a little while knows we do a lot of what we call rinse and repeat with the same groups of people, because that provides a de-risking thing. That my job at the company is risk mitigation. I'm supposed to get your money invest it in something, make the biggest return possible for the lowest risk. That's the entire uh, focus of my daily work at AllPro. And so how we do that is we find platform partners and we vet and strenuously go through people that are in the asset class we want, they're in the markets we want, and they have to have a track record of proven performance before we onboard them. And so I'm going to run through our platform partners and talk a little bit about each one, because without them, we don't have the deal flow. And, really they're the boots on the ground developing these projects, the ground up developments. And we have some that aren't, and I'll go over that briefly at the end, but we've kind of morphed over the years more to a ground up development with multifamily, build to rent, and self-storage. And so I'm going to go through and give the credit that where it is really deserved, and that's to our platform partners. Our first platform partner is Goodwin Knight, which is a subsidiary of the Challenger Group, which is Brian Barr. And they are a multifamily and build to rent platform partner, and they're national. So they go a lot of different places. They're in Florida all the way to Utah. And so if we look up here, our first project was in 2010. We have 17 active projects. We have closed out and realized profit on 22 projects over the years. Our average return, if you'll notice, Steve gave you a graph there where our average return's a little over 20% for the portfolio. You'll notice that Brian's is a little lower at 14, but if you've been around very long, Brian caps most of his at 14. So that's by design. That's all his pay. That's just the structure you go into. When you go into a Goodwin Knight project, it's structured differently, and those return 14. So that's not like it's underperforming the portfolio. That's just the way those are structured. So his results actually drag down some of the other platform partners when we're looking at that 21%. And currently we have slightly over $112 million out with them today on those 17 active projects. The next group is also related to Brian. A few years ago, I think many of you might know Brian sold part of his home building company to a publicly traded builder for a diversification play, basically to lessen his position in one market. And through that process, he decided that maybe he could have more time and energy he has a lot of, and he went to markets that he liked, and he's standing up new builders in markets that he likes. So he'll underwrite the market from a fundamentals of a for sale housing, and then he basically franchises a builder in that market. And we currently, it says 20, but it's actually closer to 30 of those builders over the last 4 to 5 years. And those are funded by our AllPro 4 and 5 debt funds that pay a fixed rate of return, and that money is used to fund the construction loans for these 20 to 30 builders all across the country. You can see we've got a pretty good diversification of geography. That was part of Brian's strategy. Let's get spread out. Let's not get concentrated in one state, one city. And so that's what we call the National Builder Group, and it's a Brian Barr Challenger Homes affiliate. And that's where your debt funds, AllPro 4 and 5 are. That's currently those pay 10. AllPro 4 is fixed at 10. AllPro 5 is at 10, but it's variable. And there's $156 million in those two funds. The next platform partner is O&M Living. They're a subsidiary of a home builder in the Dallas-Fort Worth, Houston market. It's an 80-year-old. O&M is the subsidiary. The parent company is called History Maker Homes. They are an 80-year-old business, fourth-generation home builder in that market. And about 4 or 5 years ago, they wanted to diversify from for sale product into for rent and then for sale. And we partnered with them to do that. Our first project with them was in 2019. We have 7 active projects. We got off to a great start, timed the market awesome. We've sold 1 project, and the average return now when we say returns, I want to make sure everybody realizes this isn't the project return. This is what the investors got paid. So this is net of AllPro and the platform partner. This is what the investors made on this project. So it made 58%, which is super exciting. Other than it sets the bar really high, and everybody expects us to do that every time. As we all know, that's not going to happen. But we did really well with that project. They're a super solid firm, 80 years down there. We really couldn't find a partner that's been in the market that long, that knows the market that well, that has all the subs lined up, because they're doing build to rent only. And so the difference there is they're not building apartment buildings. They're very risk averse. They stayed with duplexes and villas, which are cottages, which is a duplex, and a house, which is a villa, because they knew how to build that. They didn't want to venture very far off of building houses, which they'd been doing for 80 years. So we're super excited to have that caliber of a client and a platform partner to be able to help deploy your dollars. And those are some of the fastest growing markets in the country: Dallas, Fort Worth, Houston. Our very first platform partner was brought on 7-8 years ago. It's Uplift Development. You might remember them, Grow Your Storage. They're our self-storage platform partner. As you might see, we've run through some of these slides. We have multiple platform partners for multifamily build to rent. That's different geographies, different cities. Uplift is national. They'll go anywhere. And we only have the one. We started with them in 2016. We have 20 active projects. We've closed and sold 18. Our average return on those investments is 19%. I will tell you that's probably a lot harder to do than the 58% on the one project because it's a lot of consistency and you have to do the right thing over and over instead of just the one time. So I'm super proud of Lee and his team at Uplift Development. We currently have $71 million out to the Uplift group. Sunflower Development is a fairly new platform partner. They're in Kansas and Missouri. They're a multifamily developer. Our first project with them was in 2022. It's active. We don't have any sold projects with them. There's no return because we haven't made one yet. We have 14 million with them. The project that we do have with them is a multifamily project. The picture's up there called The Lanes because it's on top of an old bowling alley site. So we saved all the wood and made shelves out of it. It's kind of cool. That opened up September 1st and we're 40% leased, pre-leased in the last 45 to 60 days. So off to a good start. Yellow Tree is our Minneapolis, Minnesota multifamily builder. Our first project with them was in 2023. We have 2 projects with them. We have not closed or liquidated out with them yet. We have no return to report. There's roughly 17 million. Our first project with them, which is called Oakdale / renamed the Harlan, is on budget and on time on the construction. It opens in November and we're 20% pre-leased. Right Development is a multifamily. Well, they do a lot of things, but we only do multifamily with them. They're a little broader based, but we stick with what we know, which is the multifamily and self-storage. Utah, Idaho, first project 2023, active projects 1. We haven't sold out of that yet. No return to report, $7.6 million. This project, it's a lot of buildings, a lot of smaller buildings. I think the last building's set to CO, our last building, in October, and we're pretty much leasing them as fast as we can complete them up there. I don't know what the exact percentage is because not all the units are finished, but we're having great success leasing as we go. We ventured a little off the path and did a car wash with some very well-known local folks that have a great track record with car washes. It's called Vibe. It's in Aurora. It's a one project that we have with them. And we have 3.5 million deployed with them. And if you've been with us a longer time, these are the assets that we used to do before we kind of went on the platform partner mode, and where we were just finding the projects ourselves and we were buying value add apartments. We've done 7, we have 9, we have 2 active, 7 closed. You know, a lot of these were the early apartments we did out in Las Vegas, the Lionstone apartments that we did here. You know, those, when we don't have a platform partner, and we timed market right, obviously those projects have done really well for us, about a 43% return to investors on that group of 7 closed projects. So we owe a great deal of thanks to our platform partners. We're always looking to add new platform partners because people come and go. You never know. We don't sign contracts with these people. It's a handshake. We do a good job for them. They keep coming back. Many of these companies are trying to scale, just like Allpro. They're looking for a consistent source of capital. They like dealing with the same people over and over. And when we say what we mean by de-risk is that if we have 7 projects with the same group and there's a problem with one of them, they're very anxious to solve it because we've all got a lot of things going on. If you do a one and done with somebody, and things don't go your way, they might just hand you the keys and call it a day. But, these are long-term relationships that are, they're not documented, but we've been in business with these people a long time. We intend to stay in business with them. But that's just another way that I think we can take risk out of it for you guys as the investors, because these people are motivated to solve problems. And there's always problems. All these numbers sound pretty splashy and the returns are really good, at least in my opinion. But it's not always the sausage is in the, nobody wants to watch the sausage get made. And it's a little like that. It's not easy, but we owe a lot of a debt to these people, and that's how we're going to continue to grow the business. So with that, I'm going to let Eric come up and talk about what we're going to do going forward.
Can everybody hear? Future. I joined All Pro right out a year ago. I've met some of you. Moved here from Kansas City, my wife and I, of 30 years. We left our 3 adult daughters there. They're doing just fine. So one of them's actually in town right now with my wife. So, I've known Tony Bettis for, we think it's about 30 years. We think it's in the mid-90s we met, and done a ton of business together. I've always been in some form of banking or corporate finance, again, managing risk around financial transactions, whether it's building a bank or, in the 08, 09, working through tough loan portfolios with the banks we were with. But that's my background. It's very similar to Tony's with regard to risk. So again, my job, I think the big steep growth curves that Brian Barr has set forth, Tony thought he needed some help. So we were talking, and from a family standpoint, it was a good time for us to come out. So I'm here, and what I do day to day is much the same. It's staffing, it's risk, it's working with the platform partners, it's working with our underwriting department, it's putting deals together, taking our developer partners, making sure that deals underwrite. That's a big part of what I do. You can see, hopefully you can read that at the top, organic platform partner growth. We have, I think if you interviewed all 7 of our platform partners, they would say pretty good things about us. We do expect them to fix problems, and they do. It's awesome how they step up, and it's understood that, we work through things together. I would say they like us because we're flat, we're reasonable. And I would say that if they deal with Wall Street money is looking for any instance to hit them over the head and take something from them. And it's more of a transactional type feel. We really try to be good partners. We've done 100 and some deals, and I think we've had 2 capital calls. So, I mean, we fix things before they end up on the investor's plate. So helping Lee Frederick with Uplift is a great example. Lee used to do 1 deal every other year. He met Tony and All Pro, and now Lee's doing 5-6 deals a year. Lee has a staff. He has civil engineers. He owns a steel company. He has, in his ability to scale, he has de-risked his business, which de-risks it for us. So that's what our growth, actually, you'd think growth can cause risk. It actually de-risks for us and our platform partners. Some exciting new platform partners we're dealing with. We have a mobile home park platform partner. He's got 7,000 pads and 60 parks in 10 or 15 states. He's been around doing it forever. Super high quality person. We're working on a deal with his group. We have if you remember the Goodwin Knight slide, Goodwin Knight has a joint venture with Clayton Homes, which is owned by Berkshire Hathaway. We all know who Warren Buffett is. And the joint venture for them to build for rent down near Pensacola, they're bringing $10.5 million of equity. We're going to raise 10.5. It's always great to have, the builder boots on the ground doing the work that has $10 million at risk right next to yours. So that's a new exciting partnership. We have a senior living. If you've ever run across an O'Reilly Automotive store, has everybody seen those? That's a family office out of Springfield, Missouri. It's a big public company. They've got $11 billion net worth. They have a senior living division. I know them through some old banking relationships, and we're working on our first senior living deal with them. They've done 20 on their own that their family has self-funded, and now that they've got their model nailed down, they're going to use outside money, and so that will be. You'll see that coming in the next few months. That's super exciting. Some of the other strategic things we're doing, Frank with Adveneer is going to talk here in a minute. And we like to partner with financial services firms that think like we do. So we are incredibly sensitive about investors, your money, taking care of you. We're investor first. The way we are compensated is structured such that we don't get paid till you get paid. That sort of goes to intent. What's our intent? Our intent is to take care of you. That's why we get paid last. So we're motivated to make sure things work out. When partnering with CPA firms and wealth advisories, that's going to give us an entree into their client base that's also interested in All Pro investments. It will offer some more current pay offerings. We do a lot of ground up development, so we don't have a lot of current pay that pays quarterly, and the access to the new investors. And so that's a big reason for doing that. The CPA firm we're talking to right now, we're under an LOI with them. They actually own the trustee that we use for deferred sales trusts, which Frank's going to talk about. We want to own half that firm because we want greater insight into how our clients are treated. And so we're making additional investments in those type of firms, also to help facilitate growth. And so that's really what I'm up to. All of this facilitates growth, and the larger the number of choices that we have to offer you guys, if we have a platform partner that all of a sudden has a problem that maybe doesn't make the grade, we've got one to replace them, and that's super important. Choices and optionality is incredibly important in our business. I'm going to ask Frank to come up, but I want to tell you that Frank's one of my favorite people that I get to work with. He's in our office, and when you talk to Frank, you never hear mine. What you always hear is a story about helping somebody, and why we partnered with he and his lovely wife, Tony, somewhere here. Thanks for coming, Tony. She's a big part of that business also. Massive, we aligned, our intents aligned. Frank and Tony are all about serving their clients appropriately. They always put the client interest in front of their own. And it's really fun to work with Frank and watch their business grow. And so Frank's going to come up and talk about his firm, and then also Deferred Sales Trust, which is a incredibly, it's a 20-year product that a lot of people don't know about. It's a structure that's been tested and vetted, and the firm, the CPA firm that we're under LOI with is my tax firm of 25 years. And they've been doing it for 20-ish years. They've been doing deferred sales trusts. So it's been around. Frank's going to talk about it. Come on up, Frank. Thanks so much.
Thank you, Eric. Thank you very much. So again, my name is Frank Vaughn with Adveneer Wealth. I founded it in 2019. And first, I want to say thank you to Eric, Tony, Steve, the All Pro team for putting this together, and just an amazing business relationship. As Eric said, the feeling's mutual. To find a firm that puts their clients first, it's unfortunately rare in the finance world. And what I'm going to talk about tonight, I'm going to give you a little background about myself, my firm, our team, what we do. I'm really going to focus on the deferred sales trust, which it's an innovative tax solution. As Eric mentioned, it's been around for 20 years. It's fully vetted. There's case law behind it, so we'll talk about that. Go through a couple of interesting cases that we've worked on, actual success, and then I'll open up to questions. Promise you it'll only be about 15 minutes, so Tony won't start throwing things at me and kick me out of here, but wrong way. So again, Adveneer Wealth Management. Again, I'm a certified financial planner. I am a product of Colorado Springs. My dad was a retired colonel in the Air Force. We moved around a lot. But I actually went to Air Academy High School, had baseball scholarships, spent 4 years majoring in baseball. And then when I decided to take my, my education seriously, I actually graduated from UCCS and Dwyer School of Business. Reason why I bring it up, if you know anybody that has college-age kids, students, it's actually really good. I feel like a hidden gem. Great, higher education institution here in Colorado Springs. Put me much further ahead despite my best efforts. But from UCCS, I was actually recruited right at the beginning and right in the heart of the financial collapse that we all got to live through. And at T. Rowe Price, I was recruited there to be part of the Enhanced Personal Services Group. So that was $1 million plus investors where we'd really just do like mutual fund strategy. That was it. You hear things like seek the advice of a competent tax professional. I have to give you 3 referrals. Or my favorite, which you guys will all probably laugh at, which is real estate's not an investment, right? A company like All Pro sounds too good to be true. It's probably a scam. I think I said that myself. But as we all know, and part of my background, the people I've seen that have actually generated wealth, that put themselves in a good spot, they use not only real estate and the market, but another income generating investment too as well. And that's true diversification. So when I heard that All Pro was looking for a partner in the wealth management world, it was a great fit. But that's a little background about myself. After T. Rowe Price, I ended up going to Fidelity. At Fidelity, I was part of a team with 2 different financial consultants. We managed 2 individual books right up, over $1 billion each. And then I took over a book, was ranked like in the top 1% out of 1,000 reps, but was asked to start selling more proprietary products. So nothing against them, they're great firms. They're just they pigeonhole you in what you can do. And so I went to be independent, and that's the form, or how I founded and the formation of the firm. My lovely wife too as well. I gotta tell her thank you. We're entrepreneurs through and through. I tell everybody I'm finally at the point where I get to work half days. I'm excited about it, and I get to pick the 12 hours of the day. So if you're an entrepreneur, you know it's a gift and it's a pain that it's hard to explain. So she has put up with that. She actually has a degree in finance herself. She managed a team at T. Rowe Price, and I finally convinced her to come back and not work for me, but work with me and manage a firm. So she handles operations, the internal working, the management, and then Sarah, we're very fortunate. We just brought on Sarah. She's actually a transplant from Chicago. She worked in the legal field. She worked in the nonprofit space. So from the charitable planning, the nonprofit giving that we do, she is a fantastic resource, and that's part of our team. And as I mentioned, wealth management, kind of how we look at it, it's predicated on this theory that you're going to make a lot of money. You're going to need to open up tax-deferred accounts. You're going to need the tax write-offs. You're going to work, and then you're going to retire, and magically, you're going to be on a low tax bracket, right? And people that do a good job, that actually build wealth, invest in real estate, save, put themselves in a good spot, their tax bracket does this for the rest of their life. And so we really manage what we do. We say integrated wealth management solutions. So we give tax advice. We do the typical investing. We do a lot of things. We do business valuations. We have offerings in private equity, structured notes. We really love All Pro for the real estate portion. But where we're going to focus is something, it's an innovative tax solution called the Deferred Sales Trust. And I'll get into that too as well right now. So Deferred Sales Trust, it's just a sales name. What this really is it's a trust that we put together so that if you have a highly appreciated asset, it says real property up there. So what's real property? Real property would be highly appreciated real estate, something that you bought for a very low price, that you developed, did cost segregation studies, fully depreciated it, you have an extremely low cost basis, and then you have this massive gain that you're going to have to sell and realize the taxes on. That's a fantastic opportunity for the deferred sales trust. Another thing is a business. You go from being an entrepreneur, as I told you, I'll ramble on about the entrepreneur's journey. You know, you're told don't take the risk, keep your health care, keep your benefits. You can't pay yourself, can't even make payroll. Then all of a sudden you wake up one day and you say, how am I paying this much in taxes? And then when I sell it, I'm going to be put into the top tax bracket, which, by the way, the top tax bracket statistic, it averages around 800,000 returns a year. And of those 800,000 returns, a small percentage are actually there year after year. A majority of them are there for 1 year. And that comes from when you sell a business, sell real estate, highly appreciated stock. So what we do is, instead of taking that haircut and getting hammered by the tax code, we use the tax code to defer those payments over time. And so that's what this is. We create a trust, we put your asset in the trust, we sell it so you have not gained what's called constructive receipt. And how we do that is you have a financial advisor and you have a trustee that manage that. Then they create a note to pay you back over time. And the beautiful thing about the note is you can dictate the terms. It's something that you can adjust. And this is all based, and I promise you I'm not going to quote tax code at you, the Internal Revenue Code, but IRC 453, and specifically 453A, has to do with an installment sale. So there's actually congressional recognition that you do not have to pay taxes during the sell. You have to pay taxes when you realize the gains or when you take constructive receipt. And so that's what we use. It's a trust that is set up with a note. You dictate the terms of the note. And the beautiful thing about the note is you can defer the taxes for a couple of years. You can invest in All Pro. You can invest in a bank account. You can invest in other real estate. One thing too, how I found this and how I got into this, I'm a real estate investor myself. My wife and I, as we were having kids, we were flipping houses and we were using exemptions from short-term capital gains. Or if you're familiar, there's the 121 exclusion, which has to do with $500,000 worth of gain. And then there's also the 1031 deal that we've done all of them. 1031, the thing that's tough about 1031 is you have that 45-day identification period, the 180-day placement. So they, through the tax code, force you to make a quick decision on what you're going to buy or what you're going to identify. Another thing too as well is, you're selling a highly appreciated asset and then you're going out and buying a highly appreciated asset. So with this trust, it gets rid of that timeline to where you can sell the property, invest in cash, invest in the All Pro Fund 5, get 10%, find another suitable property a year, 2, 3 years down the line, then invest in that. So it gives you a ton of flexibility. This is a nice little diagram that we found that you can kind of see the schematic of how it works. So first, you take the property, and then by the way too as well, I don't know if it was mentioned, we're going to email these to you, so don't feel like you gotta write it down or anything like that. You'll have it, so you can review it on your own time. But you basically take the property, put it into a trust, the trust sells it on your behalf, then you create a note, and we spread the taxes out over time. So we can intelligently pay taxes. We can do it on your own terms. And if we do it right and we work with your accountant, we whittle down your adjusted gross income. We try to get you in the lower tax brackets and pay significantly less over time. Not to mention, the investment can grow in that trust and be invested while you're taking payments out. So one of the things that we do, I told you I'm a real estate investor with myself. People that have 1031 constraints, highly appreciated assets, I've run into people that their plan is to die instead of paying taxes, which I understand, but pros and cons to everything, right? So this will allow you to not only spread out the gain, You can change your investments too as well. You can invest in other real estate. You can fully depreciate that again. There's a number of benefits that I promise Tony I won't get into the weeds, so we'll stay high level. But it's a way where people, again, and I have to stress, if you do the 1031, you want to manage it yourself, that's always the best direction. That's going to be one of the easiest ways. But if you're tired of managing property, if you want to diversify, and another thing too as well that I really have to hit on. So All Pro, what's interesting about them, the customer satisfaction that high, right? I mean, the numbers, they really speak for themselves. $272 million that they've created is amazing. This is a product of Tony and the team listening to you guys. Their number one complaint that they get is, I have to pay too much in taxes. Why don't you guys offer a 1031 program? 1031s are complex. There's so many different things with their limited partnership, how they invest. It would be a drag on your returns. So this is something that I've worked with them so that we could come up with a solution for people that wanted a 1031 into All Pro. And we've had a lot of success with it. This is an actual example, actual one that we did. Somebody was offered $5.1 million on the real estate. At the taxes that they were looking at roughly $1.4 million in taxes. This example on the left is if they just paid, they would net $3.6 million. On the side, what we set up for them is we set up a trust. There are fees involved. One thing to keep in mind, there is a minimum viable product. We generally want to look at around $500,000 worth of gain. That's where this really gets fun. And that's how we can justify it and you come out on top. But there are fees to set up a trust like any other trust. There's going to be management fees. It's roughly the high end is 1% when you're paying the trustee fee, when you're paying the wealth management fee, our fee. That's a high example. But from this, they were able to net $4.9 million. It's around $1.3 million difference. And what you can do is you're taking the money that you would have paid in taxes to the federal government, you're using that to invest in compound. We lower your adjusted gross income over time, you pay less in taxes. So this was a fun example. Next one, told you I won't bore you entrepreneurs. We help people that are selling businesses. When you have worked your whole life, put your blood, sweat, and tears in the business, then you have 30% lopped off from the tax code. Or anybody from California, you ever want to see 50% taxation, sell something in Orange County? I'll show you. Actually, there are thousands of these trusts set up. A large majority are done in California for that reason. But another example that we did, we had somebody that wanted to sell a business. They were offered $1 million. They said, hey, I don't want to negotiate. I think it's a low price. How can you help us? We got them connected on the other side with a business broker, which pros and cons, I love doing everything myself. But depending on you and where you're at in your business, having professional help can really get you a better deal, as you see. So instead of $1 million and paying $267,000 in taxes, we were able to get a $1.3 million with all the other, there's a fee, there's commission to the business broker, there's a trustee fee, our fee, everything involved. It's still, she ended up netting $1.2 million. It's almost a $500,000 difference, real money when you start looking at it. So those are a couple of examples of what we do. Finally, this trust too as well, we get all the time, hey, I've built this, I've built a legacy, I've tried to get my kids to come in, learn the property management, learn what we do in real estate, learn to run the business. Unfortunately, I won't bore you with statistics, but all the statistics show that when money's passed along, it generally is not successful. So part of this trust creates a very interesting opportunity to where we can set up a legacy. So not only you pass along your money, but your values too as well. So you can put this in a trust. You can have a trustee put stipulations on there so when you pass it along to your children or the next generation, there's stipulations in place that they have to follow. You can have them keep investing in All Pro. You can have them keep investing the way that you would like. And we set it up. It's a pretty interesting way to do it. And then anybody that's charitably inclined, you put the money into the trust. We create a charitable giving strategy so that when you do realize these gains as well, we write them off by giving from this account to where then you can have your other accounts that you can use however you want. So a lot of different applications on it. really right now, I think we're going to open it up to questions. And if you have any specific questions, we do complimentary reviews. We put together an analysis for you. Just reach out anytime. Be more than happy. And I don't know if we're going to all field questions or, yes, sir.
So Frank, on those two examples, you said tax. Did you say they deferred earlier over the following years? So really the net gain really
Yeah. So
because I mean that amount would be taxed that but you end up paying that same amount
So the question, did everybody hear that? So in the example we had up there, the net tax was 0, and that's 0 for the first year. And you said it's a very good question. The mechanics of this trust, it depends on your situation. So it's like the name says, deferred sales trust. So we are deferring those taxes. But what we do is it's not like we put you in the trust and then say, hey, you have to pay these taxes over time. We try to spread them out. And the great thing about this trust is that you can go, we do not like going past 5 years. Like 3 to 4 years you can defer without paying any taxes. So as an example, the one where it was $1.2 million. You can take that money in the trust, you invest with All Pro, make roughly in the All Pro Fund 5, $120,000 a year. That grows over the next 4 years. You're going to have a much bigger bucket within that trust. What we do then is we work with your account to try to lower your adjusted gross income, pull out capital gains, because the tax code's designed to be confusing, right? There's your income tax bracket, and then there's the capital gains bracket. If we can get your adjusted gross income below, it's roughly $580,000 for married filing joint, you're not paying that 20% tax bracket, you're paying 15%. If we can get you below 94,000, you pay 0 on long-term capital gains. Now it filters through, it's complex, but we go through and saying, you're still gonna pay taxes, but through this strategy, it's gonna be significantly less over time. And you can defer it, have the trust grow, you can have significantly more assets within that trust that you can pass along. And this note, generally we do 10-year notes. When you come to the end of the 10-year note, you can rinse and repeat, you can do the same thing. So you can keep deferring the taxes over time. But yeah, you're still paying taxes. So, but it depends on your individual strategy. We've been able to whittle people's adjusted gross income down low so that then they're paying significantly less in capital gains. And sorry, was that? Yeah. Yes. Absolutely. So yeah, the question was, how does this integrate into your estate planning, and how do we do that? So this trust, it's like any other trust. You can set it up, you can put stipulations on it, you can set it up for the next generation. And so what we do is we go through, we look at your full life. We say, are you charitably inclined? What are your goals to pass these assets along to the kids? Are they responsible enough to create the investment strategy? Or would you like us to continue yours? And then through the trust, what we do is then we can set up a payment plan for the kids. We can continue to invest. And like I was telling you, where it really gets fun is there are different things that we can do, and this gets in the weeds a little bit, but we can set up to where we set up a charitable giving strategy to lower your taxes and your tax liability through this. There's multiple things that we can do. But from the charitable side, it's really great. We can also buy life insurance from this and set up and give a ton to charity that way so that you're still passing along significant net worth to your kids. So it's pretty complex, but there's a lot of things that depends on your individual situation. We create a plan to make sure that it aligns with your goals and the values for your money.
Building off that, I'm wondering, does that go in conjunction with like a living trust, or does this take place of a living trust?
This is going to be completely separate. So this, we're playing a little game, and I think Eric told me not to say it, but we're playing a little game called Screw the Government, right? So this trust, we do not want to put assets into it that we're not trying to defer taxes. Your other trust and your other estate planning are going to be separate, but we tie this all together basically into your estate plan, but it will be a separate trust.
Are there other asset types that qualify?
Great question. Thank you. So the question was other asset types, what qualifies? That's the beauty of this trust, and that's why we really used it, is that the 1031, the code states specifically a like in kind exchange. This does not. Once it's in the trust, you can invest however you want. So you can invest in cash, you can invest in the stock market, you invest with All Pro. We can even set it up so that we pull money from the trust to invest in your own individual real estate deals. So it gives us a ton of flexibility. There is not any stipulations that we've run into. It really kind of depends on the trust. Correct. Yes. And so what Tony was saying, to elaborate on that, is that think anything that's capital gain. If you guys come in and you say, hey, I got $500,000 of W-2 reportable income, there's things we can do, but you're in trouble. If it's a capital gain, anything, the sale of a business, like what Tony said, the sale of art, the sale of real estate, anything that's going to have a capital gain. We even helped a gentleman that had airplane hangars, and he bought Tesla when it was like nothing. And he had like $1 million gain in Tesla. You can actually do this with highly appreciated stock too as well. Yes. Sorry. That's all right.
A little controversial. I'm in the dental field.
Okay.
And they've recently had some articles coming out about trust becoming targeted by the IRS. What are things that you do to try to help make you a target for individuals as they join with you on something like this?
So every year there's the IRS like Dirty Dozen that they put out there. I don't know if you saw last year, they actually put Crutz and Kratz Charitable Remainder Trust on there, which that's something, as I was going through school, that was like the bread and butter of like estate planning. And so to fully answer the question, what we've done, and I forgot to mention, the way that we connected with the gentleman that we trust, your biggest risk, and I'm trying not to ramble, I'll answer your question, I promise. But your biggest risk within this, more than anything else, is that you put it into a trust and you have a trustee that isn't good. And so the trustee is the biggest vector of risk. And so that's why All Pro, through Eric and Tony, we've worked to make a relationship with this guy, Brian Whitmore, another gentleman out of Missouri. His name is Todd Campbell. He created this strategy like 20 years ago. So if you set the trust up, part of that trustee fee is audit defense. If you ever get audited, you don't have to pay out of pocket. They want to defend this because they have defended it in IRS court and got a no change filing like in the low 20s is what they've told me. So it's time tested. It does have a strategy that's tied together. And so if the IRS does come after this or anything along those lines, what we have seen is that they will generally make you pull the assets out over a schedule, is what the talks would be. But that's what the IRS generally does. This is not like some complex tax shelter that's on the IRS radar. This is something where you're setting up a trust, you're creating an installment sale, it's in the code. So never say never, but the risk of you being audited or the risk of them coming back and changing this, I mean, it's slim, but we are talking about taxing unrealized capital gains, so.
Hey, one point, Frank, on the trustee.
Yes.
That's the trustee associated with Brian Whitmore's firm. And that trustee was formed specifically for Deferred Sales Trust. Glenda Redding, she's a CPA, she's Brian Whitmore's partner. That's all she does for the most part is service the Deferred Sales Trustee clients that are in Brian's firm, because Brian Whitmore's been doing this for 20 anyway. So my point to the trustee that we're using is it's a Deferred Sales Trust trustee specifically, and that's on purpose, and that's the firm that we're buying half of.
And that's just to elaborate on what Eric said. He's actually used this strategy himself, and a huge application for it that's not as pertinent around here is actually like crop rotation strategies, heads of cattle too as well. Feast or famine, right? You have 2 or 3 lean years, then all of a sudden you have this massive gain. they've used this strategy so that they can spread those gains out over time. And the thing that's great is even if it's 2 to 3 years that you can spread that out, that can be a huge benefit from you from a tax standpoint. Most people we know set up a 10-year note. They strategically pull the assets out, and then they renew and do another note so that they continue to build a legacy. So, oh yes.
Here, let me give
Is a separate entity that has to file its own return?
It does.
Return to pass through your
Ye- So the question was, is this a separate entity that has to file a separate return? Yes, it does. And so the trustee from Buffalo Capital Services also does accounting too as well. And they generally put together the trust return for like $1,000 fee is on the high end. But yeah, they will work with your accountant and make sure that they put together a return too as well. But great question. And then keep in mind too, you can grill Tony.
Yeah, we're going to do that. Tony, why don't you jump up there? Because I have a question for you. And Steve. Steve Ossis, jump up there. Steve is invaluable. He is a huge unsung hero. He manages money flows, investor. Yeah, he's really done an incredible job. I really appreciate Steve. He's a wonderful, invaluable employee of All-Pro.
Well, yeah, we wanted not to kick Frank out, but this, you can ask questions about All Pro too.
So here's a question. How's the election going to affect what you do, Tony?
Yeah. Well, that's a great question, and we get asked that all the time. And so, what I would say that so that I can defend it is, we've been in business for 15 years, and our returns have averaged 21%. There's been a couple of elections through that period that went both ways. And so, what I would say is, I'm an economics major, and what we do is supply and demand. We're supplying real estate that's in demand from somebody wanting to rent it, and then we sell an income stream to somebody else. And so while elections will come and go and rates will go up and down, and sometimes that's great for us when cap rates compress, we do Bell Station and make 58%. But over the long haul, we're a supply demand, and that isn't changing with elections. I mean, if you listen to Kamala, she's trying to tell everybody, hey, we're going to build 3 to 5 million houses because we need houses. We agree. We're massively undersupplied on residential for rent and for sale in the country. Now, there's markets that are having a little bit of a glut right now, but I would also say that that's a good thing in a way, because starts have dropped anywhere from 40 to 70% for multifamily across the nation through this last year and a half. I mean, they're plummeting because they're hard to underwrite. People are scared and they think there's an oversupply. The good news is if you're still starting a few, you're going to deliver those when there's a dearth of new supply. So I would say we're more supply demand. And we're not, elections will affect us slightly, but it's mostly interest rate driven. And we all think that's going our way just because of the economy. So I don't really see that has a big impact on what we do over the long haul.
So on the first couple slides, there was information about where we're going in the future. Can you touch to that a little bit on what the plan is in the next 5 and 10 years on growth?
Sure. The slides were up there, but we're at 1,000 investors. Our goal is to get to 2,500 investors in the next few years, and then get to 5,000 investors in the next 10 years. And then we're at 580 million assets, or your money under management. We're going to try to get that to $1 billion, and then we're going to try to get to $2 billion. Those sound like big scary numbers, but when I met Brian Barr 10 years ago and we had 15 million and he said, hey, we're going to get to 500 million, I'm kind of, sometimes my sense of humor, you got to watch it. I'm like, well, if you just pull your lips off the crack pipe, we might have a chance. So what I would tell you is, it sounded like a big number and I was like, that's ridiculous. But here we are. I've been at it 10 years since then. And, the good thing about it is, and Eric touched on it, the bigger we get, the easier it is to grow. In the early years, it was very hard to grow. We had limited product offerings because we didn't have 7 or 8 platform partners. We didn't have any when we started. And so going from where we are now and the track record, what I will tell you, I'm the most excited by, quite frankly, is the fact that I love all of our platform partners. They're great folks. We owe everything to them. But we're now going where you can, what Eric visited about, we're now talking to the Berkshire Hathaway folks as a potential JV platform partner. We're talking to the O'Reilly Automotive people as potential platform partners. That could have never happened 10 years ago when I started at the company. We couldn't have gotten an audience with any of these people. So the fact that we always show up with money, we try to be easy to deal with, we've got good results. We're now attracting people that are going to make it way safer for you to make money with us going forward, because those are the kind of people we want to partner with. Those are the folks that we're now can attract as we go forward. And Eric says it's optionality. We get calls all the time. People want your money. They want me to get it from you and give it to them. And so we talk to potential platform partners all the time. And we're super selective because it's your money. And we need to make sure that we're partnering with the right people to de-risk these things such that we can provide reasonable returns for reasonable risk. So that's what excites me most about going forward is the new platform partners that we're starting to entertain. And there are also two new asset classes, the senior living, which is new to us, and the mobile home park pads is new to us. And these are proven operators, great folks, different assets for you guys to diversify from the ones that we have today.
I agree with everything he said, but I also want to focus on how we got here, and that is with all of you people in the room. And while we're going out to bigger players and, Berkshire Hathaway and others where we want to leverage this great environment, we are all depending on you as well to get us to the next step. So that, is continued investments, continued returns that you're getting. Hopefully you feel confident enough in us that you will continue to give us referrals to your friends and families, because that's how we have been growing and want to continue to grow. So we're counting on you to get us over the hump as well. There's a couple of questions here.
Yeah, I don't think I'll need it.
Okay.
How much in these projects that All Pro Capital is involved in, how much co-investment does All Pro Capital put in, and as well as the partners that you guys do?
Sure. So that's a long and winding story. And it's a good question because the Wall Street model is usually 10%, 5 to 10% from the development partner. I will tell you, and many as you might know, years ago, we had a hard time getting everybody into the deals. We would get massively oversubscribed in amount of hours. And so what happened over the course of time is we just quit putting money in. So there wasn't any co-invest because that meant you couldn't get in. And so while that maybe isn't standard and there is some risk in maybe not getting a co-invest, as Eric said, with the Berkshire Hathaway folks, they're bringing half the money. That's awesome. 10.5 million, we'll put in 10.5. That sounds pretty good. So we do try to do that. The O&M living folks down in Texas, they put 10% in every deal. That's just because they want to do it. They think that's a sign of good faith. They want you to, as the investor, to know they're doing that. I would say that on many of our other platform partners, sometimes it's 0, sometimes it's 5%. The Berkshire Hathaway thing's going to be 50%. On Brian's models going forward, he's putting in money every deal. So when we go out for a Goodwin night, multifamily or a build to rent, let's say we're going to do $10 million raise, he's probably going to put in a minimum of 30%. And so it'd be a 30% co-invest in that standpoint. That's going forward. We hadn't historically done that. Yeah. So the platform partners also guarantee the debt. I mean, so All Pro has no debt. Obviously, you guys don't sign the debt as investors. So one thing that binds these guys pretty tight is they're signing a big loan somewhere. And so that's the other thing as an ex-banker, and Eric's a banker, and we could bore you with the details and I can talk forever, but you have to find a platform partner that can scale. And what that really means is, can they go borrow $300 or $400 or $500 million? Because if you're going to do 10 projects, you've got to have the ability to go down to the local bank and have them want to loan you some money. And so that's the other thing. When you look at these projects and you see the capital deployed, That's probably, historically, it was 30% of the cost. Now it's more like 40%. So somebody's signing a note for well over double what that number, I mean, they're putting the debts there and they have to sign that. And so that's their other buy-in, is that they're signing that debt. And uh, I'm a little bit of a quirky underwriter sometimes because I like the co-invest, but I also don't want people to get some false sense of security. Because believe me, if it all goes bad, that 10% ain't going to save you. I mean, it sounds great and it is a good idea. And if people want to do it, but we wouldn't turn away a great platform partner if that was the only thing that we didn't like. And also, as we said earlier, these people are trying to scale. So the more money I make them put in, the less deals they can do, because then they run out of money. So it's a governor on their growth as well. So it's kind of complex, and we don't follow the traditional models. We just try to mitigate risk at every angle. That is a risk mitigator. I see it as one of the lowest level risk mitigators, quite frankly, but it is standard that if you go to other places, they're going to tout it. Hey, everybody puts in 10, 20%. This is great for you. I'm not saying it's bad. I'm just saying it isn't the end all.
Just add one more thing and then we'll get over here. A couple of the things I'm most proud about with All Pro Capital is, number one, we've never lost any investor principal over 15 years. I'm very proud of that. The other thing I'm very proud about is that almost all of the employees, past and present, have found a way to come into an All Pro deal. Now, is it for half of a deal, half of an apartment complex? Absolutely no, not. But all of our employees have brought family members. They found a way to invest with their 401k or whatever. They're the ones, as Tony mentioned before, who are back there making the sausage, and they like what's going into the sausage, and they want, a piece of that sausage. So, all of what Tony said is correct, as far as the co-invest. But the people who are, behind the scenes, whether that's legal department, whatever department we have at All Pro, they're finding a way to put whatever money they have into a deal.
Yeah. And so what I would say is, as a company, we don't generally set a metric. I can say I'm in almost all of our projects personally. So there isn't maybe a company co-invest, but several of our employees and owners, Brian Barr is one of our largest investors in the actual deals, just like you. He puts in money just like you. So we don't make it a company co-invest from the GP or us, but as individuals, we're heavily invested in these projects.
I have a question right here. You mentioned there's about 1,000 investors today. What's the demographic and where are they located? Well, I can see that, as most of us are trying to retire or retired. Where are they? Where are most of the investors, the 1,000?
I would say 70% are in Colorado, 65% in Colorado, and the rest scattered across everywhere. And we do get concentrations like in Texas, where we have O&M Living and we have projects down there. Naturally, it's easier to attract investors when they can drive down the road and look at the projects. You get a little better participation rate. Mm-hmm. But I would say that, way back in the historical, they were all local. But as we've gotten referrals from friends and family and CPAs, and we've moved to different markets, I would say it's probably a 2/3, third mix.
Is the office here the only office?
Yes.
But we do have other people in other areas that will be working for us. I'm getting on a plane tomorrow to go to Utah because we sponsor BYU football, and we've been getting a lot of BYU fans, amazingly enough, as well. So but you are the demographic. You are exactly what our investors look like. Just 1,000 more like you.
So when you're looking at equity investments, it seems the model that I've seen most is you develop it, you start filling it, and then you sell it. That seems to be the majority of the models. On multifamily, have you thought more about build it, fill it, and instead of selling it, managing it, so that we can see more of the depreciation aspect of that and more of the cash-on-cash returns that come out quarterly from that, for people trying to retire and have cash-on-cash delivered on a regular and frequent basis, rather than typically we would wait 3 years, maybe 4, to a project to sell, and we know we're going to get 14% accumulated. But you got to wait 3 to 4 years to get that. And unless you have a queue built up, you're going to have difficulty retiring.
Yeah, and I would say that there's a lot of reasons for that, but I agree. And as if you've been with us for a while, we used to sell stuff kind of periodically, but this hasn't been a great market to sell. So we're not selling when it's not a great market to sell. It's easy math. I'm a rounder. It's easy math. We've got 48 active projects. They take an average of 4 years. Okay, so we should be selling a project one a month. That's it. Once you get going, we should be selling something every 30 days. Well, we've only sold 2 projects in the last 2.5 years because it hasn't been a good time to sell. Now, I would say in 2021, we sold like 15 projects. We sold $275 million worth of real estate in 2021 because it was an awesome time to sell. So we're strategic about when we sell, but you're right. And I would say that, quite frankly, I'm pretty transparent to my own demise. We're selling yield. And so the best yield is the faster I can get you in and make you a bunch of money and give it back to you, the yield is higher. Time is my enemy, because if I make $100 and it takes me a year, or if I make $100 and it takes me 10 years, the yield is 10% of what it was if I did it in a year. So if I hang on to these, the big pop in value is build it, rent it, and sell it. That's the biggest lift in value. And the quicker I can realize that, the higher the yield. If I hang on for 3, 4, 5, 10 years later, you'll make more gross and you can take advantage of some of those things, but your yield continues to decline. You can't make 21% over the long haul if you hold on to these projects and you never sell them. You're just going to hang on and make the 6-8% dividends. And so our model, for good or bad, is, I grew up super poor and I like to make money. I like to cash checks. And so a lot of our richer clients don't like that model because they're like, dude, you're always selling something. Well, like there's never a bad time to make money. So I've built the model because I built it. I've built the model on 3 to 5 year exits because that's the highest yield. It helps me attract more dollars. It helps me attract more investors. That's how I grow. So yes, we're not for everybody. We're looking for more current pay stuff like our debt funds and some of these other funds. We realize that's a little bit of a hole in our market, but I wouldn't look for us to change strategies because I'm looking to produce the highest yield I can for the lowest risk. And when you build something, you're in at cost. That's a great place to be. Construction cost is a fantastic basis to be in any asset. And then we're just going to value it and get rid of it.
Just to follow on to that, do you see the interest rates now that they're starting to come down? You'll see some cap rate compression.
Boy, I sure hope so.
On the properties that you're in. So does it make sense in that scenario, especially if you get a 2 or 3 point drop in interest rate?
Sure.
3 point drop in cap rate, that value is going to go up.
Which is why I haven't sold anything in 2 years. I'm waiting for that cap rate compression. And, as these projects lease up, the thing about it is, and I want to make sure, because this gets super complicated. Because typically when the markets were good, we build, fill, and sell. And sometimes that's 3 years, not 4 or 5. So we don't hold on to them. They get them full and we sell them. So for the last 2 years, we've been hanging on to them for just what you said. We're looking for brighter days on cap rate compression. So to give you a great example, the Bell Station, the big 58%er down there for O&M, the very first project we did, we sold that at 3.25 cap. That's how you make 58%. Cap rates today are probably 5 if you're lucky, 5.25, 475 to 5.25. That is like the difference between here and Mars on evaluation. And so we are waiting for cap rates. And we are starting now to get deeper into these projects that we haven't sold, and we're starting to pay some pref. And I don't want people to go, well, hey, you've been in that for a long time and you used to sell them, but now you're holding them, but I'm still not getting paid. The issue with that is that the banks don't always want us to pay. So it's not that we don't have the money, but there's covenants on our debt that say we can't kick money back to investors until we meet hurdles for them that are very long-winded, trailing 12 months this and blah, blah, blah. So they don't want me to pay out to the investors because they see that as depleting the cash in the entity they've loaned money to. So we're now getting to the place where we can start kicking out cash. On 4 or 5 of these projects, we're now paying pref. Where years ago, we would have just sold them and you'd have gotten your accrued pref and your profit the day we sold it. So I agree with you 100%. I'm just waiting for those cap rates to come down and away we go. We're going to sell, sell, sell.
Yeah, as the company grows, which it will, is there a point at which you say, okay, we need to expand as far as physical buildings, meaning like an office in the southeast, maybe an office in the northwest, to attract more investors?
Well, sure. Yes. So we, at what point? Well, I would say it's more like selling something. It's more about strategy than it's about timing and strategy. We are hopeful to buy that CPA firm or 50% of that CPA firm, which is Emporia, Kansas. Let's call it loosely. It's Kansas City-ish. You know, that it's got the trustee, all the things we've talked about the DST. It's got the trustee and all that nonsense we won't keep boring you with. But they've got investors. They've got 2,500 clients. 1,000 of those are accredited. Those will be people that we're going to talk to. We have a guy we're going to hire as soon as we close that. We want to give him some work. So we're not going to hire him until we get the CPA firm bought, but we do anticipate opening a Kansas City office, which we've got quite a few projects in and around Kansas City. So I would say next year we'll have a presence in Kansas City. We did have a guy in Utah for a while that didn't really work out. We tried that. It didn't work. So yeah, I would say that we will look at it, but we're really going to do it more by acquisition and hiring of different people, individuals that will work out of their house or a WeWork. We're not looking to recreate what we have here in multiple cities. No, yeah, we don't want a whole bunch of overhead somewhere else.
Two questions. I'm curious how much influence Allpro has over the general partner's tax strategies, and that's related to the next question, which is, for example, if Allpro could offer an investment opportunity that would guarantee, that an investor could take X% bonus depreciation in 2024, for example, a lot of investors would invest tomorrow, but I think to do that, they would need to do a cost segregation study, et cetera. I think the alternative would be to try and defer that and spread that out over a few years. But it seems like that'd be a viable alternative to maybe a deferred sales trust.
So we do try to maximize the tax savings. We do cost segregation studies whenever they're advantageous for us. I remember this was more by luck than by strategy, but we bought a apartment complex in Las Vegas with Cheyenne Point, it was called. And we did a cost segregation right when Trump was elected, 2016. And he did some retroactive, policy or whatever. Anyway, at the end of the day, the first year write-off depreciation because of this cost segregation was more than 100% of each limited partner's investment. So if you put $100,000 in that investment, the first year, accounting loss only, you showed, what was it, Mike? Because I don't think you enjoyed that very much, right? You had $110,000 loss that great. I mean, that's good because you can offset it against other income. We had not anticipated that. I mean, certainly we want to maximize whatever we can as far as depreciation, but and we do that. Sometimes it really hits us hard or good in a good way. Now that's deferred, right, to some degree. So we do what we can, but that I wouldn't say would replace the advantages of a DST either. We just do the best we can with cost segs and whatever to maximize the early depreciation. And all of the partners do that. They have the same advantage. They want to do that as well. So. Anybody else?
Going
Going?
once,
All right.
twice.
Oh, one more. Yes. Good.
I was just wondering with the supply and demand, sometimes with construction and supplies, is that going to delay? Have you seen that?
Yeah. We'll let Tony answer that.
Yeah, so I would say that was more of a couple years ago. We're getting past a lot of that now. It was super bad a couple, 3 years ago. I think on like our 532 Colorado, which is like a 50 unit thing down in old Colorado City, we were waiting, you know, 9, 10 months for like a transformer or something, and they were telling us it was going to take 2 years. And so yeah, but a lot of that's passed. The hyperinflation of the materials and the scarcity of materials, that's a long past us. It's much more stable now than it was, which is a good thing, because those kinds of things were very hard to model. Because nobody saw a lot of that coming. So I would say we're through the majority of it. I would say right now the biggest issue is labor. You just the trades, our development partners have a very difficult time finding enough people to get the job done on a timely basis. I would say that laborers are still our biggest across all the markets. That's our biggest problem, is getting qualified labor in to finish the projects on time.
Any other questions? All right, well, if you waited to get food until the end of the meeting, you're out of luck. It looks like it's all gone. They've hauled it away. So if you would, before you leave, there is a survey underneath the note paper. If you wouldn't mind jotting down a couple comments, you can just leave it on the desk there and let us know anything, whatever's on the top of your mind there. Just let us know and we'll aggregate those and get back with you. So thank you very much for coming. Appreciate all of your support in the past. Look forward to that support in the future. We're very confident, very excited about where All-Pro's going, and hope you'll come along for the ride. Thanks.
And I do want to say, sometimes asking questions in a big group, people are shy, don't want to do it. We'll hang around a little bit. If you got something you want to address after this, we'll hang around. Or you can call me, Eric, Steve, anytime you want. We're super accessible. You should never be afraid to call me, Steve, or Eric about anything that you have a concern about, or walk into the office. Nobody ever comes in. We'd be glad to see you. So we're available. We want to talk. We want people to be confident. We don't want to feel like you're not getting what you need. We try to be super transparent, whether that's good or bad. I mean, whether we get good news or bad news. We want to just tell the facts are the facts, and we're always going to share them when they're available. So don't be afraid to call us at any time.
Thanks for
Thank
coming.
you.
Thanks for coming.